Let us now begin our panel discussion. Moderating this session will be Mr. Colin Low, Assistant Manager, Macro Research, FSM1 Singapore. On the panel, we have Mr. Christopher Wong, Client Portfolio Strategist, Southeast Asia, Fidelity International. Ms. Christy Goh, Director, Intermediary Business, First Santia Investors. And Tony Raza, Senior Director, Head of Multi-Asset Strategy, UOB Asset Management. Over to you, Colin.
All right, thank you, Geraldine. So without further ado, let us begin today's panel discussion. So today's panel discussion will be centered on how to build an all-encompassing portfolio given our current investment climate. So I'd like to jump into the first question right now. So for the first question, I would like to get a panelist's view on today's asset allocation in the current investment climate. So I would like to direct this question to Chris as well as Tony. So in light of the market as well as economic developments seen today, as well as the COVID developments we see throughout this year, so how should unit trust investors position their portfolio between equity as well as fixed income? So maybe we can start off with Chris first.
Sure. Now, we always advocate having a balanced portfolio with allocation that suits individual investors' needs, circumstances, and risk appetite. Now, as at the moment, we are still currently quite positive on the global macroeconomic outlook amid a still very supportive monetary and fiscal backdrop. So it makes some sense to add a little bit, to have a slight risk tilt within portfolios. So for us, we are slightly overweight equities with a preference for more value, cyclically oriented sectors. And in fixed income, we have a preference for corporate credits, which to us has more value over government bonds, for example. And they are not less sensitive to interest rates movements in the short and medium term.
I would agree. I would add that I think usually when we make recommendations for investors, we do recommend thinking about sort of like a cycle approach. And so where we are in the cycle now is after going through a severe recession in 2020, we're starting an expansion cycle that is likely to last several years. And as such, then we do lean towards growth assets, which does mean carrying more equities than usual. And that also, given the fact that long-term expected returns are quite low for fixed income, that's even like on a structural long-term basis, we're carrying more equities. I would add, though, I think like Chris mentioned, within fixed income, we do continue to focus more on the credits, and we're carrying a bit more high yield than usual.
Right. Great answer, and thank you, panelists, for the insightful answers. So I think my next question itself is something that our investors would like to know. I think this is something of a high interest for our investors. So I'll direct this question to Christy as well as Tony. So what are some of the investment themes and opportunities that investors can leverage on in the second half of this year and perhaps even beyond this year? So perhaps we can start with Christy.
Area which has not seen as much investor interest has been in Indian equities. This year has been a really tough year for India, and if you look at the headlines, you'd be surprised to note that India's performance has been in excess of its better-known neighbor, China, right? And these are two large but very different markets. If you were to look at India from a top-down perspective, it's very chaotic, there's not much policy guidance, but really they don't depend on that. They've gone through many governmental changes and they've still managed to grow from strength to strength. China, on the other hand, has a very strong top-down approach, which means that as bottom-up stock pickers like us, we almost have to think like the Chinese government, and that's not the easiest thing to predict over time, as you can see. So India has always been very self-reliant in terms of the companies that we invest in. So companies had to rely on themselves even during COVID environment. They had to ensure their employees were safe from COVID. They had to ensure that they had oxygen supply, makeshift hospitals, and company guest houses, basically, right? If you look at other factors like capital discipline in India, it's far stronger because they haven't had the luxury of easy and cheap access to capital like, say, China would have, or a lot of other markets. And I guess lastly, as I end off, if you look at where India is in terms of product penetration categories, they still have a really long runway to go. And I think, it will be a market that will continue its growth traction for a good number of years to come if we pick the right companies.
So I would add that our key focus is we think there's a growing big opportunity in Asia as a whole. So it's Asia fixed income, but even more so Asian equities. There's several points to it. We highlight that firstly, that on a long-term structural basis, Asia tends to go through long periods of under or overperformance. There was the early 90s where Asia strongly outperformed, the late 90s where it underperformed, the 2000s where it performed great, and then the last decade where it's been a strong underperformer. In the last decade, compared to the US, Asia's underperformed by something like 150%. And so there, on top of that, there's a lot of like exciting mega trends in the world that we think that Asia's really positioned well for. These include a lot of the things I think everyone knows about, but it's things like, where the demographics and where all the millennials are, they're all in Asia. Where the growing middle class is, all the middle class growth in the world is coming in Asia. And in the past, Asian companies used to be sort of like contract manufacturers for the West. But now, as we pour through the investment opportunities in Asia, there's so many companies that are well positioned to harness this. And so I think the underperformance of the last decade, we don't think it's going to continue forever. Asia right now isn't performing the greatest, but we think there's a big opportunity that's going to last for several years.
Great. Thank you, Tony, and thank you, Christy. So a lot of our investors have shown a great interest in Asia and more recently in India as well. So I think those are really good and valuable insights for our investors to hold on. So my next question will be on another hot topic that is occurring in recent years. So there has been a lot of chatters as well as talks within the markets on sustainability. So it is certainly an area that our investors would like to understand more as well. So I would like to direct this next question to Chris as well as Christy. So regarding sustainability, what are some key considerations that investors should take note of when attempting to invest in sustainable products? And also, what are your thoughts on greenwashing? So can we begin with Chris?
Sure. Maybe I start on greenwashing. So one can really think of greenwashing as adding a thin coat of sustainability to any fund. Now, the problem here is green itself has a very wide range of meanings, and sometimes investors can assume a certain standard where there isn't really a consistent standard across the board. So that's one problem. And the lack of transparency and sometimes a deliberate attempt by asset managers to put on the sustainability label makes it a bit confusing, and to some investors it could just be a false front, right? So it creates a false front of sustainability, giving kind of sustainable investment a bit of a bad rep. Now, some considerations really on when considering ESG into investments, the best way to avoid being greenwashed is to do two things. One, to know the right questions to ask, and two, to do a bit of your own homework. So questions one can consider when doing private investment is, does your asset manager genuinely integrate sustainable investing into their process? So this should be incorporated into a manager's fundamental analysis, financial analysis, etc. So this is one part. Second is the manager engaging with companies, right? So how many meetings have he done? How many has he engaged with companies with, right? Number of meetings on sustainable issues, and were there follow-ups that have happened after that? And the third one is really, is your asset manager walking the talk? Do they incorporate these sustainable practices as well into their daily business practice? So these are questions one can consider when really thinking about who to invest with regards to sustainable investing.
Well, I guess adding some color to that, just the acronyms alone that's available in the market, you have Sustainable Development Goals, you have Responsible Investment, you have ESG. The headlines could be quite confusing for a lot of investors today, right? And you have benchmarks like Dow Jones Sustainability Index, which has British American Tobacco as its constituent. So if you were to not know better and invest in a fund that uses that as the benchmark, you could be investing in a tobacco company, and by no yardstick would we consider that as a sustainable business, right? And it's not just that. There's a lot of carbon neutral, talk out there as well. And the approach that we have is quite different. We don't want to invest in, say, a consumer company that consumes ton of plastic in their packaging and then plant 1,000 trees on the other side and say, I'm carbon neutral, right? Because technically they are. What we really want to look for is a company that has started to think about packaging alternatives using biodegradable products that's just better for the environment, right? So there's a bit of that greenwashing that's happening there. And we usually like to use ESG engagement as a way to understand management mindset a little bit better. So there was a situation quite recently where we introduced a private company to two semiconductor firms that we've actually invested in. And if you guys understand the semiconductor industry, it's a very water-intensive fabrication process. So what this private company has done is that they've managed to reduce the water intensity, managed to reduce the bottleneck in wafer fabrication as well. So as we followed up on it after the introductory meeting, Company A had actually moved on to having that private company meet with senior management and gone on to proof of concept in a matter of weeks. Company B, on the other hand, had basically told us, I'm sorry, we haven't moved on because we weren't sure who to forward this request to, right? But if you look at just the surface on their annual reports, it would be the same checkbox. We have done an introduction meeting with a private company that could help our water consumption utility, but the follow-up action speaks volumes in terms of which company is truly sustainable and thinking and acting through it, and which other company is just really doing it at a very superficial level. Yeah.
Right, great.
Can I add, Colin?
Yeah, sure.
So I think there's one consideration that I hear from clients that I don't think should be a consideration. I hear all the time, like, what are the trade-offs? I think that's the wrong direction. There are no trade-offs. Not only is it historically there's no trade-offs, but in the future it's going to be very dominant that those who are not making these considerations, that don't know the science of comprehensive accounting and what all these pollution costs are and how it affects the value of the company, it'd be like hiring a fund manager that doesn't know how to do dividend accounting because he hasn't learned the latest techniques. You need to hire fund managers that have learned the latest.
Great. I think that's all. The answers are very insightful for our investors. So let us move on to the next question. I think this next question will be an interesting one. So, and I will direct the question to Chris and Tony. So what is one investment theme or idea that you consider as a dark horse within the next couple of years, say in the next 2-3 years, or perhaps even longer? So maybe Chris can start.
Sure. One structural idea we like now is Chinese tech stocks. So not very long ago, they were actually market darlings. It's really fallen a lot out of favor, given recent kind of regulatory developments in China, right? And how it's really affecting some parts of the market at the moment. Now, we really, at this point in time, we believe some of these measures are really for the long-term health of the global Chinese tech sector as a whole, to increase competition, to make it a little bit more fair for the consumer. So we think long-term wise, this is an area that we still like. And value is gradually starting to emerge after kind of the correction we've seen for the last couple of months. But really, one has to be quite selective here still, to be very careful to invest in stocks, or companies rather, with a long-term foreseeable trajectory and managed by quality management who know what they're doing and really and flexible enough to navigate the environment going forward.
So investment theme that I think is not very favored right now, but I actually think is going to have legs over the next several years, would be this whole idea about multi-asset income again. This was a area that did very well in a much longer cycle than we've seen in prior cycles over the last decade. And I think right now markets are sort of turning away from it because I think there's like a fear that bond yields are going to rise aggressively and inflation is going to make it less attractive. I think the reality is we're in a low interest rate, low inflation world for a long time. These structural forces have been around for 2 decades, and they're not likely to have just disappeared because there's some supply constraints. So I think I know we meet fixed income investors that need yield every day, and I think the way they're going to find it is by using combinations of portfolios that bring in high yield, that bring in dividend income, and that these multi-asset income, I think, is going to have legs again before long in this cycle.
Great. Thank you, panelists, for the insightful answer. So let us move on to the next question, which is also regarding another hot topic in the market right now. So inflation, like Tony mentioned earlier. So especially with the recent release in the US CPI numbers, I think the inflation concerns are beginning to resurface again. So my next question is regarding inflation, and it's directed towards Christy and Tony. So what are some sector, regions, or even investment strategies that an investor can consider in an inflation environment? So perhaps, Christy, you can begin first.
Yep, sure. Well, I guess in an inflationary environment, the baseline is you should stay invested regardless of over sectors or which countries, right? But I think specifically to target inflation and in line with the pandemic environment that we've just come up from, one theme that has been recurring would be infrastructure. So we've seen Biden's plans, it started from Donald Trump and then Biden, but really infrastructure is a lot more than that. Very often when we engage clients on infrastructure as a topic, there's a lot of education involved because they think infrastructure, they think China, Vietnam, emerging economies, but truly where we need a lot of infrastructure investments is in developed markets because the governments are strapped. They don't have cash to refurbish or rehabilitate existing infrastructure. Now, if we think further along those tracks, companies and utilities, these are inflation proof because they pass on the cost to users, right? toll roads inflation-proof. The contracts, the multi-year contracts that they signed with the government as they undertook these projects means that they can build in CPI plus as a factor into what they charge to end consumers, right? And if you think about the pandemic environment we've just come through, even the growth infrastructure assets will add a lot of value. Your airports are now at pre-pandemic levels in terms of volumes, not in Singapore, obviously, but across Europe and even in China, where domestic travel has resumed significantly. If you look at ports, cargo volume have come up quite a fair bit as well. So from both growth and income and stability to combat inflation, infrastructure is very well positioned moving forward into the next couple of years.
So I would add just a lot of the usual suspects. If an inflationary environment becomes stronger, then it's the usual things that stocks outperform bonds. It's sectors like the US dollar and gold tend to be strong. And then you also have sectors like property and commodities that do well. And if we truly get more of a reflationary type environment, those are the types of things we would be looking for. But I would still hold out that I think 1 year of some inflation numbers, I wouldn't be overly anxious about inflation yet.
Right, so thank you, panelists, for the answer. So before I close out the panel discussion, I have one last question for the panelists. So can you share more about your top funds' performance and how some of the recent market factors have affected those funds? So maybe you can start off with Chris.
Sure. Now, most of our Fidelity funds have held up quite well in recent market volatility. Now, this is supported really by our quality bias and our insistence on good bottom-up fundamental research. So examples of funds that have held up quite well in recent volatility periods are, like, for example, our Emerging Market Focus Fund, our Sustainable Asia Equity Fund, and our Asia Pacific Opportunities Fund. Or maybe let me just quote the last fund, the Asia Pacific Opportunities Fund, as an example. Now, what really has helped this year, our fund, is the bottom-up fundamental research, picking the right stocks, being flexible in allocation, and being contrarian in nature. So one thing that helped us was avoiding expensive technology stocks early part of the year. So market darlings then, like Meituan, for example, we didn't really hold most of those. So that helped on the downside. Now, we also picked up a number of quality cyclical stocks last year during the COVID drawdown. So that has also helped the recovery in the cyclical recovery this year. And third, bottom-up stock picking. So we had examples of a few good stocks which we picked a bit ahead of time before markets really realized the catalysts that were coming ahead. And that has also been a good driver of kind of alpha for us as a whole.
Well, very similar to Chris at First Sentier today, broadly our funds would have held up very well. I guess for investors who's been invested with us for a good number of years, you would have realized that we tend to hold up very well in extreme market conditions. A lot of our funds are very Asian-centric or Asian biased, which means we would have significant exposure to China. And last 2 weeks hasn't been the easiest markets for anyone over there. But thankfully, in all our regional portfolios, we've had zero exposure to Chinese education stocks. We've had very, very light weights to Chinese tech firms, like Chris mentioned. And we actually took opportunity on that front when the Chinese regulatory changes got announced in the market. We bought on dipped, we topped up some positions in names like Tencent, and that has fared much better since the announcements came out. So I think the litmus test question that we always ask internally is, if a stock fell by 20%, what would we do? Would we cut loss? Would we increase our position? I mean, if we are truly bottom-up, high-conviction stock pickers, then the answer should be we should be topping up positions, right? No one's going to go to a sale and say, you're on 20% discount, I'm not buying you anymore. That's really the wrong way about it. So I guess, bottom line is, what we have in our portfolio are high-quality franchises that remains we are highly convicted in, regardless of where the macro noises are coming through from. Yeah.
So similarly, I wanted to highlight our China A-Share Innovation Fund. I think as sentiments that have been echoed earlier, I think it's a really interesting space that obviously is getting hit with a lot of turmoil. I think the fund's ability to be able to get solid returns in a questionable environment, I think speaks to that innovation comes from a lot of different ways. It's not only a focus on tech companies, it's within the industrial space, within consumers. There's a lot of room in China to find exciting stories. I think it's obviously been a sort of tumultuous period with a lot of regulatory changes, but I think those that are able to manage this, and I think going forward, there's exciting opportunities.
All right, thank you all the panelists. So I believe today's discussion will be rather fruitful and many valuable insights have been gathered for our investors in this session. So once again, I'd like to thank all the panelists for the valuable time. And with that, I've come to the end of today's panel discussion. I would like to pass the time back on to Geraldine.